let us get to the earnings story once again. We're roughly halfway through the European earnings season, and Bloomberg Intelligence has been crunching through the numbers. The big theme seems to be sales misses, but earnings beats and better margins. Let's get a briefing now from Tim Craighead, Senior European Equities Strategist at Bloomberg Intelligence. He joins us on set this morning to take us through the latest findings. Tim, good morning. So give us a quick sense of the overall scorecard then for European corporates.
So you would think from the surface that this is a pretty good period. We've got about 50% beat. We've got about 35% miss. That sounds okay. But if you actually look over time, this is the worst earnings period on those ratios that we've seen since the pandemic lows. So, we aren't doing the normal guide and beat that happens typically.
What is the China role within this as we think about the luxury space, as we think about the auto space? To what extent is that playing through?
Yeah, it's been a key touchstone for us, a big risk factor. We did an interesting analysis a few weeks back looking at the 80 companies in the stock 600 with the most exposure. It's $450 billion in revenue, so it's a big deal. Certainly there's been concern about China's sort of economic stalling, and what we've seen, as you well mentioned, the autos have been the headline about disappointment, not only from the standpoint of activity, but also increasing competition. Standard Chartered was another issue with a concern about what's going on with banks. You've had some of the luxury companies miss. That said, there's been some surprises too. Notwithstanding what LVMH said, Hermes was okay. If you look at Atlas Copco, their vacuum business, which feeds into Chinese semiconductors, is okay. So it does vary. I'd stress one last point, though. This was an easy comparison if you think about last year with China having yet to open up. Things start to stiffen in the fourth quarter and first quarter.
Tim, that's really interesting about the base effect, saying mixed from China impact so far, but it really is because an easy comparison. I'm just curious, taking the overall earnings season so far, how do you interpret the reaction function that we're seeing from the stock market to either beats or misses, and how that compares to the prior earnings seasons this year?
Yeah, it really depends, Mark, on the sector. It's not the standard if you beat, stocks go up, miss, stocks go down. That is happening, for example, with tech and with industrials. But in financials, where the rising margin story on higher interest rates has been so important, if there's any whiff of a crack on that, the stocks have been punished severely, down 4% on average on a miss. Energy, on the other hand, it doesn't matter. It's a commodity play. It's going where the commodity is, which has been up as of late. So it doesn't really matter whether they beat or missed. Energy stocks have been rising.
Okay, Tim Craighead, always excellent with the roundup on the earnings picture so far in the context from Bloomberg Intelligence. Tim, thank you very much.